So in my mind, there's three things that I look for in a strategy. One is I want it to be scalable, but I also want it to be passive, meaning that I can scale it without working harder. And a lot of the strategies we talked about are disqualified because I can scale it, but I will get to work harder. I don't like that. But then also there's a risk.
Welcome, everybody. How's it going, Mason?
Oh, it's going. I think we just had a really fun show, and we've had a bunch of great guests recently, and we have more coming up. So the podcast is fun, business is good, and things are rolling. How about for you?
Yeah, man, it's been a fun couple weeks. Got a new acquisition manager that started that I'm very excited about. Very experienced, lots of land experience specifically. So he's closing deals already, 8 days in, 9 days in. So that's exciting. But to today's podcast, I really did enjoy this one and a lot of the recent ones because it's the same stuff, a lot of the same principles across different asset classes and regions, which just drives home the simplicity of business. So you want to tell everyone who we talked to today?
Yeah, absolutely. We had the privilege of interviewing Michael Blanc, who is a real estate investor, best-selling author of Financial Freedom with Real Estate Investing, speaker, and a leading authority on apartment investing. As the CEO of Nighthawk Equity, host of the Financial Freedom with Real Estate Investing podcast, and columnist, Michael is passionate about helping people become financially free by investing in apartment building deals and raising money. Through his investing company, he controls $300 million in multifamily real estate. And in addition to his own investing activities, he's helped investors purchase over 40,000 units valued at $1.5 billion. So without further ado, let's bring Michael in.
Michael Blanc, thanks for coming on. How you doing today?
What's going on, Bills?
We are excited to talk a bit about multifamily. It's been a rough market for a lot of people these last few years. Things have changed a lot, and so we'll get into that. But I wanted to start with a question around those who are still in business and those who aren't, because apartment syndicators were all over the podcast for years. I hosted a real estate group for a long time. We used to have far more of them showing up, and that's really diminished. And so what would you say has been the biggest differentiator between those who have survived the doubling of interest rates and those who are no longer in business?
Well, there's two ways to answer that. Number one, fundamentally, is operations. I mean, look, in the old days between 2015 and 2020, for sure, even after COVID, when the market got really hot, I mean, you couldn't screw this up. And you could buy something, really not do anything with it, and sell it for 3 years later or 5 years later for a massive profit. Now, what's happened over the last 18 to 24 months is the rents no longer increased as much, so that went away. And then the cost of capital went up a lot, so prices went down, right? Which doesn't really matter. If you're operating well and you're cash flowing, it doesn't really matter what the market's doing because you just ride it out. But what's happened, because rents no longer went up by 15% a year, you actually had to do something. Like, you actually had to operate. There was one foreclosure in Houston, I don't know, about a year ago or so. It was this big profile thing. And you look at this thing, and they literally ran out of money like 6 months into the deal. They started running out of money, which means that they had no construction budget. Why not? Because they never meant to do anything. And therefore, they had no reserves above the construction budget, because what could go wrong? So they ran out of money because they were hoping that rents would continue going up naturally. And so what happened is, there's actual operators, and then there's, I don't know what you call them, speculators, whatever, the buy, hold, and do nothing people. And it has started separating those from another. Now, having said that, so the bad operators got exposed. The problem with the interest rates is that it also was an issue for the good operators. So what I mean by that is, we bought these. By the way, if you never bought apartments before using floating rate debt, none of this matters, because right now, we'll get to that, is an amazing time to buy. But why would anyone? So 2.5 years ago, we're buying stuff with floating rate debt, which we've been doing for 20 years. And you need floating rate debt for any kind of construction project. You probably know better than I do. And so now we get floating rate debt. And now all the lenders are requiring us to put an interest rate cap on it, which is like an insurance policy for the interest rates not going up. We're like, what is this $40,000 charge on the HUD-1? Okay, that's stupid. Okay, fine. We'll make it work. Well, and that cap lasted for 2 or 3 years, right? And now the interest rates start going up. To renew that cap, that insurance policy, costs $900,000, right? So I don't care how good your property could be 99% occupied, you now have to come up with $900,000 to renew your insurance policy for a year. Now, not for another 2 or 3 years. And so this affected even the good operators. I like to consider us some of the good operators as well. But even the good operators couldn't operate themselves out of it. So it was kind of a 1-2 punch. It was a 1-2 punch where you actually had to operate well, but then you also need to navigate this financial problem, right? Which, I thought I was in the real estate investing business, and apparently I'm in some kind of financial derivatives business that no one could explain at the time.
Mm-hmm. Yeah, that is tough. That is definitely a 1-2 punch. So, looking back on the last few years, I know you said now it's a fantastic time to buy, and it certainly seems to be. Are there any major changes or maybe rules or beliefs you had that have now shifted and affected or changed how you're doing business going forward, whether it's in how you buy, operate, or the type of debt you get?
I would say temporarily, yes, but long term, no. Here's the thing. What you understand is that there were people back in the day who were saying, oh, this was 2.5 years ago, 3 fixed rate debt is the way to go. And we're like, I'm not sure, because there's problems with fixed rate debt. Let me give you an example. You have a 12-year fixed rate loan, which sounds awesome. But what if you want to refinance in 3 years or sell in 5? You have huge prepayment penalties, right? And some of them you have defeasance or yield maintenance, which again, no one can project. How the heck do you underwrite yield maintenance in 5 years? You don't know what's going on, right? So you have this thing and I'm trying to sell in 5 years, but I have a 12-year loan, therefore I actually can't sell. Had we not had floating rate debt and stuff we bought in 2019, 20, 21, we couldn't exit those deals with a massive profit, because with a floating rate debt, you can, after 12 months, you can get out for 1%. It's fantastic. So it gives you a lot of flexibility, right? So now, of course, because we've gotten our butt kicked, we're like, oh, fixed interest loans, of course, is the way to go. But even the deal we did 6 months ago still had a floating rate debt. Well, do you not learn, Michael? Well, we kind of sort of do. We just got a really expensive 5-year rate cap on it. It costs like $2.5 million. But they're cheaper now because the interest rate is supposed to go down, so they're a lot cheaper now. But it's still $2.5 million, because otherwise you couldn't do a value add deal, right? So like, okay, I just won't do value add deal. I'll only do stable, nice looking deals, and it's already harder to find deals, so that's not going to work. So I think the major lesson learned is to well, at this point, buy longer rate caps, right? But as long as this goes, let's say the interest rates go down and we're sitting at 2 years from now, I might relax my rule a little bit. The thing is, it was kind of a black swan event. And the reason I say that is we're already pretty conservative how we underwrite. We've always underwritten higher interest rates on the exit. The reason I'm saying it's a black swan event that no one could foretell is, why in the world would the lender give us a $39 million loan for a $40,000 rate cap when they knew that no one could afford the renewal, right? Back 2.5 years ago, they said, you know what? I'm not giving you this loan because I already know what's going to happen. You're not going to be able to afford it, or I'm going to make this rate cap, or I'm going to make you escrow so much money in the next 2 years that I know you have the money in the bank. No. Did any of that happen? It did not. And so the question is, you can beat yourself up in hindsight, but we did everything that we could given the information we were given, plus more, a margin for error. But this is a pretty big black swan event that happened.
Yeah, and sometimes it feels like these black swan events are happening more often. But with that being
the question, I hear you. The question is, can you survive them, right? And so for example, in 2008 recession, a lot of people lost not only their homes, their rental properties, sometimes huge portfolios. And to me, that's frustrating. If I'm spending 5 years building up a rental portfolio and now lose all of it, that's bad. Like, I don't like that. Now with multifamily, it's not nearly as bad. It's bad, but it's not nearly as bad, right? Because we can, if we're cash flowing, like I said, we can ride it out. Yes, are we undervalued now? Yes, that's bad. Boo-hoo. But I'm still making money, right? So that's what happened in 2008 with commercial property in general. They were still able to cash flow. They couldn't sell or refinance. Like, oh, okay, so I'll just wait a couple of years, right? And so that's kind of the difference. So the black swan event was bad, but it has not yet been catastrophic. We've been able to, we have a few floating rate debt. We were able to work out a loan modification, and one we were able to refinance, right? So we were able to work through them so that we got extensions on our ability. And so, we have another shot at it. So it is not catastrophic. It is a setback, but it's not catastrophic. And fundamentally, that's really what I like about the asset class. In that some sense, I like mobile home parks and self-storage also. They're much more recession resistant in that way. And I can hold on to it a little longer if I have to. But back in stuff when we bought it in 21, for example, we sold it in 18 months because it went up so quickly, right? So sometimes our hold is 5 to 7 years, but you got to adapt to the market. So back then, the profit went up so much because rents went up 25% in like a year. We're like, oh my gosh, we'd be an idiot not to sell that stuff. We only had it for 18 months, and now some of the stuff that we bought 2.5 years ago that we wanted to sell in 2.5 years, now we're like, I don't know. It might be another 5 years.
Mm-hmm. Yeah, absolutely. And you've mentioned a couple different asset classes here, and something that I believe in, and I think Dan does too, is that you need to walk before you run in business or in investing. And what that looks like a lot of the times in real estate investing is purchasing, a single family or small multifamily house, or, being a part of a syndication and passively investing. What do you believe? Because the asset classes you talked about are really scalable and typically a lot larger than, 1 or 2 single family homes.
My ideal scenario is someone reads Rich Dad Poor Dad. They're like, ooh, real estate, good. Passive income, nice. I want me some of that. Ooh, how do I get it? And they sit down and think about how they can get it, which of course I did not do. And most people don't. They're like, oh, I'm just going to get into it. I'm just going to flip a house. I'll just do a rental. But do they ever think about if that's going to get them to their destination? The answer is no, because it doesn't. Because I've tried it. I'm a slow learner. I flipped 3 dozen houses before I went, wait a minute, that's not very passive. If I'm not buying, fixing, and selling, I don't make money. That's a lot of work. And when I sell it, there's no residual. Well, that's stupid. And how do I scale that? Right? Most people can do 1 flip at a time, 6 months each, 2 flips, $100,000 a year. Cool. But what if I want to make $1 million with my flipping business? Holy cow. Now I gotta flip freaking 20 houses a year. I did 12 a year. That's a lot. Or rentals. Like, you're lucky if you can cash flow $200 a month in rentals. If you want 10 grand a month, you need 50 houses. Have you ever thought about that? Like, wild, right? So my ideal scenario is someone rich dad, poor dad thinks through this and goes, something ain't right. How do I achieve this goal? And they start looking elsewhere. They start looking, well, who has done it? Has anyone actually become financially free with real estate? How do they do it? And they will discover that while some people have gotten into single family house investing because that's what everybody does, they struggled with it for the reasons I mentioned, and then they pivot. And a lot of times they pivot into residential multifamily housing because it's an easier than going to office space or retail. And then within a year or so, all of a sudden they're out of their job. And so to me, the ideal scenario is Rich Dad, Poor Dad. And then I'll give them my yellow book, or basically introducing them to multifamily syndications. Because as soon as you get into multifamily syndications, you can literally become financially free within a year, 2 max, because of the economic model of a syndication, the acquisition fees, for example, which you don't get in single family house investing. And that's really the power. And you don't need single family house investing experience to get in there. Does it hurt? No. Is it somewhat beneficial? Yeah, possibly. But in my experience, it's normally a distraction. You can skip that and go directly into multifamily if you want to scale. Like if you just want to have a little income on the side here and there, and you're not really thinking bigger, you don't want a financial freedom or anything like that, totally fine. But if you want to quit whatever you're doing right now, you got to generate significant income.
So I guess for me, something I think about is I view flipping houses or, flipping land or as these active income generating businesses. Same thing as having a high paying W-2 job. And then, whether it's single family, multifamily, commercial, or whatever, it's that's an investment strategy. What you're talking about here, because I feel that you need to learn how to make money before you can manage other people's money, obviously, and also, take on larger projects to a certain extent, whether that's, a higher annual EBITDA or just more units or whatever your definition of larger is. So for the person that's interested in getting into syndication, what do you view as the differentiator, kind of similar to Dan's question, of the people that have succeeded becoming syndicators, personality types, job backgrounds, that sort of thing, versus the people that maybe attempt to do it, spend 20 grand, trying to create a fund or create, a private placement memorandum, and then you never hear from them again?
So the ideal person from our perspective, the kind of person that we work the best with, that is most successful most of the time, is typically a six-figure earner who has got a rental or a house flip. Now, I just said skip the single-family house investing, but here's why this is important. People who have a little bit of money, they typically are professionals, W-2 professionals, executives, or business owners, right? So they have a fair degree of competency on the one hand. But number two, if they have already real estate, they understand two things. They understand firsthand the power of real estate because they know it makes money. But they also understand the second problem, which is they can't scale it. So they understand the benefit and they understand the problem. Now all we now talk about is talk about how do we help you scale your real estate portfolio. And of all the businesses I've tried, and I've tried many, I've done software, I've done rentals, flips, and franchises, traded stocks and options for good measures. This is the only business that I would say the largest group of people can of all walks of life can start, right? And that is because of several reasons. One is at the heart of it, it's a team sport. Like with single family house investing, I mean, yes, you have a broker and you have a contractor, but it's not really like a partnering kind of team thing, right? And so people who are a little bit more in business and that are more involved in business, they understand that. They understand that it's a who, not how mentality. Now, there's still some people that are trying to figure everything out, but it's a who, not how mentality, and this manifests itself in several different ways. Number one is I build a team of professionals, property managers, lenders around me. If I have that, I can leverage their track record. I don't need my own track record because I have a bunch of people behind me, right? So that's number one. Number two is joint venturing. We talked about why this is applicable to so many different kinds of people. The joint ventures typically consist of two people. There's a capital raiser kind of person and there's a deal finder kind of person. And most people gravitate towards one or the other, and there's a little bit of overlap. But the deal finder, for example, is a little bit more numbers oriented, right? There may be an engineer or something or accountant or then finance. They're a little more detail oriented. That's very important. But those people struggle with raising capital as they're afraid to talk to people. Now, the other one are the capital raisers from a personality perspective. They don't really like numbers. In fact, the sight of a spreadsheet makes them break out in a cold sweat, right? So they're maybe not as detail-oriented. They're a little bit more, up there in the clouds. But what they're really good at is big picture and networking and relationships. So from a personality perspective, they are more likely to resonate with capital raising, and they will resist analyzing deals and talking to brokers. Now, as you know, you need both, right? And so those two personalities come together so that, for example, in our environment, someone starts working with us, the first deal that the joint venture partners do is $4 million, and they get it on a contract within six months. And it's one of the reasons for that is this joint venturing aspect. While someone is going off and finding deals and resisting the capital raising, there's someone else who is resisting finding deals, but now is talking to people, right? And so those two come together, and now they're together, are sharing a $4 million deal that pays a 3% acquisition fee. It's $120,000 for the two of them, $60,000 per person. Let's say you got a $10,000 per month burn rate. Now you get a 6-month runway. Let's say you got another $60,000 for a rainy day. You're like, you know what, wife or spouse, whoever, I think I'm going to do this full time. I'm going to quit what I'm doing. I have a 1-year runway, and I've done it once, and I have a pipeline of other deals, and we already got investors lined up. So I think if I focus on this full time, we can really accelerate this. And that is why this asset class is so powerful, because it pays a lot of money up front to the acquisition fees, which single family houses don't. Then it pays during, which is cool. Rentals do that. Flips don't. And then you get paid at the end, which rentals and flips do. So you get paid 3 times all along the way. And so that's one of the reasons that this business is able to be started by so many different kinds of people. You don't have to be the classic entrepreneur like Gino Wickman and the entrepreneurial leap. I had him on the podcast. I had a discussion with him. He goes, no, you're either born an entrepreneur or you're not. And I was like, it's not what I'm seeing, Gino. I think you're wrong. And we have a fun little discussion on the podcast.
So I'm guessing you're the capital raiser of those two personality types?
No, I'm person number 3 who thinks they can do it all themselves. And and that's a fundamental problem as well. And just because you can doesn't mean you should. And because I'm so competent, Dan, I'm so competent and smart, my biggest problem is no longer is that I figured I can do everything myself. I didn't need any help, and I'm just going to do it myself. And as a result, I kind of call myself the crash test dummy of financial freedom. I did not have mentors when I got into apartments. I didn't have mentors when I got into the restaurant business where I lost my shirt. The only mentor I had was when I started house flipping, and I had a, not surprisingly, completely different experience. Out of my first postcard campaign, I got 2 deals within like 3 months. I looked like a genius. And maybe it was, but it wasn't because of me. It's because my mentor showed me how to actually make the phone ring, what to put in the postcards, all that kind of stuff. And so my problem is, I would say, probably arrogance. I can do this myself. That's personality number 3.
Well, it's funny because there's this fine line of, to go out and do this sort of thing, you do need a significant confidence in yourself. And sometimes the line blurs between what's confidence, what's arrogance. Who knows?
Overconfidence. How about we agree on overconfidence?
Overconfidence. Yeah. And I like the whole point you made about the capital raiser type and then more the engineer, the analytical type, because something Mason and I have drilled in on this podcast repeatedly is the importance of, if you're partnering with someone, what is there needs to be synergy. They need to be good at something you are not, and vice versa. It's so easy to go out and just partner with your twin and you're both good at raising capital, but it's like, oh, somebody has to deal with the numbers and accounting and compliance, that becomes a problem. Mason and I definitely have similar flaws and similar skills. And so we're a good example of that. But to this whole conversation, talking about multifamily syndication and why it's so powerful, I've always heard it talked about where the syndication, right, that vehicle for raising money, is set up typically for a 3 to 5, maybe 10-year cycle. And you talked about getting paid along the way, getting paid up front and getting paid on the exit. But if I was going to go pursue this full time, or anyone, what do you do, or what would you recommend as far as the long term? Do you have, separately, are you buying units that you just are planning to keep for a lifetime, or do you plan to just keep doing deals forever, or do you have syndications that are structured just to go on in perpetuity?
Okay, so it depends on what stage of life you're in. Okay, I'm not quite ready to retire yet because that bores me. Okay, so I'm going to be more of the active investor. Yes, I'm looking for. Well, there's really no such thing as truly passive investment, honestly. But there's highly leveraged investments. I consider this one of the highly leveraged investments because while it takes maybe some time to do an acquisition, kind of like buying a house, and then it takes a little time to put your proper manager in place to stabilize the whole thing might take 90 days. You're like, oh, I'm glad that's over. And then you're like, yeah, what am I going to do now? I just do it again. And then you do it again. And that other one doesn't really take a lot of time anymore if you have a good proper manager, and you just do it again and again and again. And so now over time, I'm buying these properties, and every time I buy it, I get paid an acquisition fee, right? And I get cash flow and some asset management fees along the way. And then 5 years from now, these things start popping off, right? So the stuff I bought 5 years ago starts to sell now. So now in year 5, I'm buying stuff, getting acquisition fees, and I'm getting the profit from the previous 5 years. And now I'm getting double. And from that point forward, I'm getting paid twice. One's from the new deals and one from the old deals. And that's really where you can build up a lot of wealth. Now, what do you do with all the money, right? So let's say you do want to retire. Like, this is pretty cool. You have several options. Maybe with money, you can do a bunch of stuff. But so my ideal scenario is to build a company where I'm no longer in the business, but I kind of work on the business. Like over time, as these companies get bigger, you generate so much income that you can replace yourself, right? So you can replace yourself so that, now you have a COO or integrator of some sort. You're not doing the day-to-day ticky-tack stuff anymore. That's an improvement, but you're still the CEO. You're still overseeing the revenue side of things, let's say, okay? Well, at one point, you can maybe replace yourself as CEO, and now you become, you create a board for yourself, and you sit on it, and you're in the white, ivory tower waving your hands. So that's one way to do it, right? Or you could simply take that money and buy your own real estate on the side and not syndicate, right? And just hold on to that for a long time. Or you could start to refinance them if it makes sense, refinance them, return no capital and keep holding it on. That's also pretty cool. Or you can get out of the asset class entirely. You can start selling off and then putting in something else that is much, much more passive, like triple net. Triple net is like super boring, but you get a lot of benefits of real estate and the returns and the depreciation, right? So a lot of people slowly exit out of, or you can go into a DST, right? The deferred sales trust, and roll your stuff in there. And there you can invest in anything. You can 1035 into it. And now I can buy crypto. How awesome is that?
It could be awesome. I could have been a crypto billionaire if I listened to my buddy Daniel in 2015 whenever I was donating plasma to Ford grad school, and he said, buy Bitcoin. I was like, dude, I have $12 in my account. And, his person that recommended it has his own island now. And so here I am, recording a podcast in my basement. Not my mom's basement, my basement. So
also not a bad place to be.
Yeah, exactly. So, Michael, I think, I want to shift a little bit to your portfolio and some of the strategies related to, the two buckets of the deal finding operations as well as the capital raising. You have here in your bio that you control about $300 million through your investing company. What is your investor avatar look like? Because there are some people that we raise money from that are fantastic. You hear from them, you send them the distributions, you never really hear from them again. And then there's other people that are like wanting to get involved. How do you kind of identify that investor avatar and then target those people?
Yeah. So the avatar is actually very similar because we have the Nighthawk Equity, which is a passive investing. Then we have the educational company. The avatar is almost exactly the same, except that one of them makes more money. So on the passive investing side, they will typically make upwards of $400,000 or more per year. And they will have owned a rental or done a flip. That's the same thing. On the educational side, they'll make it between $100,000 and say $300,000 a year. So they make less money. And the reason is because people who are making $500,000 a year, they are making so much money that it would, number one, take a long time to replace that income. But they're also making a lot of hay that starting another business on the side, like I said, it'll take too long to kind of replace that. The better strategy for them is to make as much hay as they can while they can, but then slowly build up enough passive income so that they have the option of leaving that business in 5 or 10 years. They have a much longer runway. So they're very busy, they're very high income earners, and they are also looking for an alternative to the stock market. They understand the stock market limitations, they invest in it, but they understand the limitations. There's a volatility. Their returns are typically around 10%, and you don't get any tax benefits. Okay, so this is why they look into alternative investments like real estate or oil and gas, or God forbid, crypto, right? So they are looking for alternative investments, but they don't really want to exit what they're doing right now. But they're looking about 10 years into the future. Like in 10 years, I don't want to be running my very profitable business anymore. People are making 100 or under, let's say, $300,000. They oftentimes don't love what they do all day, and they feel like they can't make any more. And so there's a ceiling. And for them, they're looking for a way out. There's typically the average person is like 40 years old. They've already worked 20 years and theoretically have to work another 20 years. So they've had 20 years of pain build up, and they can't see themselves working another 20 years. So they're looking for a way out now. They don't want to wait 10 years. And so if you want to get out now, you got to become active. You got to become the entrepreneur. You got to become the GP, their general partner. And the good news, when they do that and they get involved in multifamily, they can get out of their job very quickly as a GP.
Okay. Yeah, that makes sense. You want someone that's earning enough so where they don't need to quit their job, and they almost have those golden handcuffs, but not necessarily the, ultra high net worth individuals or earners. But what do you think, or let me back up a little bit. You've obviously raised a lot of money. You are, the investor, you're the author, you're on podcasts, you've got your podcast and everything like that. What medium do people find out about you and want to invest with you? What's the most popular medium?
It's hard to say. And I don't know if I can actually answer that question authoritatively because there's so many different media that people are on. We recently started actually doing paid Facebook ads. And I didn't think that accredited investors hang out there, but apparently they do. Brendan Turner's thing is all Instagram. Do accredited investors really hang out on Instagram? Well, apparently they do. A lot of people are having success in LinkedIn, which is more intuitive. Okay, I see that professionals and high net worth, they hang out there as well. The biggest thing is you just got to figure out you got to pick one. You got to pick one, and you kind of got to go deep on that platform. and you got to kind of master it first. So paid Facebook was not, right? I mean, we're putting out content a lot and things of that nature. The biggest mistake that people make to raise capital online is number one think it's the easy button to raise money online. There's programs out there that teach you how to hit the easy button to raise money on social media, but it makes no sense because why would someone on social media start wiring you money? Like, it makes no sense. There's got to be a nurturing process. But first of all, you got to capture leads, right? Because you don't know who's following you on Instagram. Heck, even if I sell a book, I don't get the name of that person. People on my podcast, I don't get the name of that person. So they do all these things online and they can't really actually speak to them as a person. And so the biggest mistake that people make that go online is they don't really know who their avatar is. You ask me what our avatar is. They're not clear about the avatar. They just kind of put stuff out there, right? But if I'm a doctor, right, and I'm probably going to raise money from other doctors. So speak to their avatar as a medical doctor if you're a medical doctor, right? If you're a professional athlete, it's going to be professional athletes. You speak to those people differently than anybody who's got money. So they don't know who they're talking to, number two. And some of them haven't even raised money before. Like, they don't, right? So how can you amplify a message when you don't even know what the message is? Stupid, right? So you got to raise money first so you know who your avatar is. You got to know what they're thinking. What do they want? What are they afraid of? What are their biggest questions? And then once you know that and you've raised, $500,000, now you can go online. Now you know your avatar is. And then people make the mistake of not being able to capture the leads on their website. What they do is they put up a website and there's a join my newsletter. Who the hell wants to join your newsletter? No one wants to join your newsletter, right? But if I'm a medical doctor and I have a lead magnet that says, hey, how you can replace your income or how do you build income so you don't burn out being a doctor so you can enjoy doing what you started doing, something like that. Other doctors go, yeah, I surely would like to know how I not burned down from this job before. And I'll give you my spam email at least. Now I have an email list that I'm building up, right? Now I can talk to them. I can start sending them email. And so now I'm nurturing them. I'm building trust with them, right? I'm putting out maybe a blog or a video. They see my face. They listen to my voice. Now I'm building trust. And when I do a live campaign, however, all of a sudden now I'm able to raise hundreds of $1,000s seemingly effortlessly within days. And most people who try to raise capital online skip all these steps because they think there's an easy way to do it.
Yeah. I think that it's really important to have clear expectations on the timeline to do this, right? To build trust with people to the point where they're wiring you hundreds of thousands of dollars and doing it online. They have to see you consistently for, not always, but oftentimes years, right? And that's really what we're doing, all of us with social media is, 5 years go by and someone that looked at us and thought, hey, what do they know? They're too young. And they're still in business. Maybe they do know something, right? And that's really the power of it. So, Michael, I really want to talk about a point we have on our note sheet here of why now is the best time to buy. Because this is always such a tricky thing where, when it's a great time to buy, nobody feels like it, or most people don't. I bought a couple fourplexes last year because I got them at a big discount from what they were selling at in 2022, 2021. And there's a lot of upside in rents. And one of my friends who's a big apartment investor told me it was a bad deal, but he's struggling right now. And I think that influences it. So that's kind of the reality of it. A lot of times is, 2010, people thought real estate was dead. So number one, why do you think now is the time or a great time to buy multifamily real estate? And number two, how do you deal with buying in face of that very negative sentiment? Because I'm still hearing it.
Yeah. Those are both very real questions that we face today. So let me answer both of them here in turn. The first one is you got to understand what's going on 2.5 years ago versus now. The environment is completely different. Like it's almost like within 2 years, we did a market cycle swing that normally takes 7 to 10 years. 2 years ago, the interest rate outlook was generally up because we were basically at zero, right? So everybody, yes, interest rates are going up. That's obviously why they made us buy interest rate caps. They just didn't know it's going to go up 11 times in a row. But yes, everybody felt like it was going up. Okay, we're using higher interest rates in our underwriting, blah, blah, blah. We knew cap rates going to go up as well. Okay, everybody understood that. But in the swing of things, it's not really an ideal economic environment to buy in if you already know that your prices are going to go down because interest rates are going to go up. So that's boo, right? So, but we knew that. The second thing also is at the same time, because it was so frothy, lenders were showering us with money. So we had 80% loan to value on these, loan to cost on these deals. Loan to cost means I can get 80% of the purchase price. Cool. I can finance 80% of my fees. I can finance 80% of my construction. So the leverage is like the most you can get in history. Like at the because it was, of course, we're all printing money. What can go wrong? So lenders are showering us with money, which is awesome at the time. But again, everybody knows the higher the leverage, the riskier it is, and the lower the leverage, the less risk. But you got to find a balance because otherwise you don't make money. Okay. Fast forward to today. Today is totally different. Today, interest rates are flat to down. That's the prognosis. Okay, that's better. Flat is better than up. Down is better than flat. Okay, so that's totally different. The outlook is time. And so that will affect prices, right? If interest rates are going to go down, obviously prices are going to go up a little bit. But here's the other important thing is the leverage we're using is much, much lower. Like, I don't know, about 9 months ago, 9 months ago, let's say, the most we're getting is 65% loan to value. That's just to the purchase price. No more fees, no more construction. That's gone, right? All gone. And in fact, lenders were so desperate, 65%, you can't make money anymore, right? It's too much equity required. They were layering pref equity, something called pref equity, which behaved in this case. They didn't have any step-in rights or anything like that. It just behaved like another more expensive loan so that you can get up to like 70. So we're buying stuff with 70% loan to value, right? Totally different risk spectrum, right? And so you got to understand why is now a good time to buy is because the risk is totally different now. The risk is different and the outlook is different. So the interest rates are going down, but also look at the fundamentals of the asset class, which have never changed, by the way. The demand for affordable rentals is huge. Okay, it's huge because we're, depending on who you ask, short $3 to $5 million homes. And the number of permits pulled for apartment housing is down by 81% because once the COVID money ran out, it's been way too expensive to build new stuff. So no developer is developing anything. They're all sitting on raw land. Maybe you guys are seeing the same thing. No one's pulling permits. So we got a whole bunch of stuff being finished up that was started in 2020 and 21 that's coming out, that already came out now or going out for the next 6 months. After that, nothing. Nothing's coming out of the ground. So what's that going to do to the rents? Rents are going to continue climbing again, and they probably won't climb at the historic 2.5%. They'll probably climb something more like 3.5% to 5%. So I like the long-term outlook of multifamily. So combine that with the prognosis for interest rates and the low leverage we're getting and buying stuff right now. That's why I'm saying it's compared to 2 years ago where people were like, yeah, it's a little hot, but if it stays about the same, we'll be okay. It's totally different ball game right now.
Yeah. Yeah, it absolutely is. And can you speak a little bit to the following the trends and making the decisions and buying new acquisitions when the sentiment is still negative among a lot of people?
How does that affect you if the sentiment is negative? It affects people. It affects their ability to raise capital, and it affects my educational business because not as many people want to get involved, right? So, but let's say I decide I'm going to get into multifamily. So it's going to be a little harder to raise capital, but that's really at this point only if I've already been in the game and I have investors who maybe got burned or they invested previously in multifamily syndication and there was capital calls or no longer get the distributions, or in some case they lost everything. Like those people, it's going to take them a while to come back to multifamily. So me as a new syndicator, when I'm raising capital, I'm going to have to probably raise capital from people who've never invested in multifamily before, which is a huge setback because in the olden days, people would just invest with this operator and that operator. We're like sharing operators. It was fantastic. Really, really easy way to raise capital. That is no longer the case. So it's a little harder to raise capital. And I'm concerned about it because we're trying to raise capital ourselves. But I feel like collectively, we're going to miss a huge opportunity. And we are now in this last deal we have under contract right now. For the first time, we have some of our investors coming back to us for the first time, especially the big ones. So what I'm finding is that there's different kinds of investors of the accredited sort, but the sophisticated investor they're always looking for an opportunity. Now, they're very risk averse. But they're always looking for an opportunity, right? So they understand that when there's blood in the streets, there's an opportunity somewhere, and they are looking for that. They are a little more discerning. They tend to be a little more objective, not as emotionally charged, not reading the news as much, but really looking at what's really going on. Those are the ones that are asking questions. And they're piecing these things together, and they're like, interesting. I know I got my butt kicked here, but I see that now the environment is totally different. The outlook is different. It's different now. I'm buying the same asset differently than I did 2.5 years ago, and they're starting to come back. So my appeal is to the investor is to really don't look at the news. It's very superficial. And these guys are trying to get eyeballs, obviously. And the more sensational that sounds, the better it is. But really look behind the scenes of what's going on right now. The people who are buying, how are they buying it? Ask them questions, right? And because I'm afraid that I think that these deals we're doing now, which are smaller, because we can't raise enough money, as much capital as we did 2 years ago either. I bet you those deals are going to be wildly profitable. And of course, they're the smallest we've done in a long time. My concern is that we're collectively missing a major opportunity, kind of like we did in 2008. I mean, 2008 and 9 and 10, no one's buying houses. Like everyone's like, oh my gosh, houses bad. And then there's some people who backed up the truck back then. I mean, wild.
Yeah. Yeah. And that's what I was trying to get to. You mentioned 2008, and that's the easiest example where so many people missed the boat because the sentiment was so negative, and it can be challenging to, even if you're thinking, I think there's an opportunity here, when everyone, even people that you might consider experienced and more knowledgeable than yourself, are saying, oh, no, that asset class is dead, right? And it's kind of the psychological side of things. But I think the point is focusing on the fundamentals like you are, as far as building permits pulled, direction of interest rates, demand that's projected, so on and so forth, I think is really the key there.
Yeah, but let's look at the office space, for example, right? There's like way more blood in the streets in the office space. But recently there was an article in Wall Street Journal where I don't know who it was, some big private equity companies moving in with billions to buy up office space. Now, when I see that, I'm like, Now, if I were in office, I'd be like, what are they seeing I'm not? Like, why are they backing up the truck? What are they actually seeing that I'm not? And it's always interesting to see when the big boys get in. I'm curious. The sophisticated investor should start asking questions when people are still buying. The very few that are, why are you buying? Are you an idiot? Or why? What's behind you buying that? And trying to understand that and see if it makes sense to you.
Yeah, I think that's a great point. And I mean, you see some of the macro changes that are going on, specifically like in office space, where federal government has to go back to work, a lot of the big institutions and big four making people go back to work. But beyond that, it's also, okay, well, if they're doing it, I should do it. But also they can go, raise money at 2% over a 30 or 40 year timeline because they're raising hundreds of billions of dollars. And so they're not always in the same boat. But something I want to shift gears a little bit, Michael, and talk about operations, where whenever you're acquiring, a multifamily asset class, the formula is simple, right? Of increase revenue, decrease expense. What are some obvious quick win opportunities that you have identified that are improving efficiencies and reducing expenses in those like smaller size? Because I see some notes here talking about 50 unit apartment complexes, which aren't huge. So you can't get too much economies of scale, but they're not so small you can't just have them like a fourplex.
Operations, Mason, so boring. Oh my gosh. And this is the problem, right? Because there's nothing as exciting as buying stuff and raising capital. And I think a lot of people in the business really didn't pay attention to operations, which is one reason they are where they are. But, when you're flipping houses, you say you make money when you buy, which is actually true. If you buy it correctly, you're going to make money unless you really screw it up. But with multifamily or any commercial real estate, you don't make money unless you execute. I mean, if you bought that thing and you hold on to it, there's nothing's going to happen to it. You've got to execute on it. So operations is super, super important. So there's some ways to go about some ways to go about doing. Number one is you got to put the right property manager in place. And that is one thing I like about this asset class. It's already built into the business model, a manager. Like, it's unusual for someone to self-operate a 50-unit apartment building. Single-family houses, it's very inefficient, it's very expensive, and you're hit and miss because you have some kind of part-time agent managing your property. And so as a result, a landlord manage your own property. Boo, not very passive, right? I do like mobile home parks, self-storage, but the people I know that have really scaled in that area, they have confirmed that you cannot put a property manager in there. You got to do it yourself. And so I don't want to do that. Okay, at least, that's changing now. So I really like to focus. I'm trying to look and see what can I do to move the needle as quickly as possible, because not just increasing rents and decreasing expenses, it's you want to increase the NOI, which of course you do by doing what you just said. But sometimes I may want to focus on revenue first and not touch the expenses, because I think the payoff is going to be big. So I like to look and see what can I do to move the needle first. So it could be expenses, but it could also be the revenue, right? So the first thing I look for is, what is the market rent? Without having to do any kind of renovations, a lot of times these properties are mismanaged. They've been owned for 10, 15, whatever years, and the owner just raised it never or by 1%. Meanwhile, the market is up here. So very simple, just by management upon natural turnover, I will increase the rents to where the market is, right? And then lumber people might move out, but they're not dumb either. Like, oh, okay, finally they got me. I might as well stay here. Otherwise, I got to pay the same thing and move, right? So just simply raising rents where the market is the easiest one. And then typically a lot of times the reason we buy stuff is because there's a value add opportunity, which means that there hasn't been really any renovations made. Meanwhile, there's, other apartment buildings of the same type, same year that have had renovations. And as a result, their rents are $300 higher because it just looks nicer, right? And so I'm going to raise money for a construction, and I'm going to start turning over 2 or 3 units per month, or whatever the case may be, upon natural move out, and now I can charge that higher rent. So I will focus on that first, unless there's something egregious with the expenses. Like I look at the expenses, and as I'm doing due diligence, I compare their expenses and utility bills and stuff like that. And maybe there's something I see for good measure. You should always have a requote for your insurance policies and trash policies and that kind of stuff. At the end of the day, you need the right property manager in place, because all these things I'm talking about are operations things, which you shouldn't be doing. So it's very important that you put the right property manager in place, and then that right property manager will take care of all these things for you. And it helps to get on the same page with the property manager, see if they're seeing the same thing you're seeing, and then you simply hold them accountable. You say, okay, what is your plan here? Here's a construction plan. We're going to do this. We're going to do that. We're going to create up a pro forma for the first quarter. If they're off track, there's a conversation. And if they can't get it back on track, you might have to replace them. The good news is in this asset class, there's 9 other property managers typically that you can hire very quickly to replace them. You don't have to train them. You just hand them keys. And it's going to be a bit disruptive, but it's not like you have to train them like a new employee. So those are sort of some things that we look for. But the bottom line is that most syndicators don't pay enough attention on operations. And that's something that we learned early on. We're like, if we don't pay attention to operations, this won't go well for us. So that's why we have invested pretty heavily in operations.
Yeah, and I think it ties right back into kind of the first questions that we asked you of who has succeeded and who's still here. It's the great operators, because whenever you can, throw money at the wall and you're going to make a ton of money on any deal, you don't even have to think about the margins. Then you're not going to be looking at every P&L and saying, okay, how do we put revenue in the first position, drive revenue through increasing rents to market rates, and then also how do we cut back, on expenses or whatever efficiency strategies there are. But something we haven't spoken about, first 3 rules of real estate are location, location, location. Where should people be looking to buy in 2025?
Well, they should always look to buy, and that is in places that are growing, both population and income, but also in a place where you can buy cash flowing properties, right? So that disqualifies, New York, Boston, San Francisco, San Diego, right? Because while those places might be growing, growing again, your chance of getting a cash flowing building is very small, right? So you were looking in more like towards the middle of the country or Texas or the Southeast, things of that nature. There's a lot of markets that are growing. And the last component really is to find a market that is big enough for deal flow, right? So typically you want to be looking at 3 to 5 deals a week, something like that. And, I love Huntsville, great market, but it's kind of a small market. So I couldn't underwrite 3 to 5 deals a week. So if I really love Huntsville, I might have to find another market to sustain the deal flow. Ideally, though, you want to try to minimize the number of markets that you're in. So if you're going to be in Huntsville, find something that's relatively close by, or pick a larger city. That's why we're in Atlanta, but there's other large cities in the country, all over the country, that can sustain the deal flow, and then really go deep in that one area, because you can share resources. You can have the same property manager using the same systems, the same P&L format. You can share managers between the property if someone's sick or quits. There's a lot of, also reduces the risk perceived and real to the investors, right? If you're like, I'm going to go into Houston for the first time ever, the investor's going to go, yeah, okay, that's pretty risky. Versus, hey, I already got 20 properties in here. This one's right next to my other one. You're like, oh, cool, right? It reduces the risk as well. So those are some of the things to pay attention to.
Yeah, I think it's really important there that you're highlighting the not going in too many directions and getting really good and building some economies of scale in a given market. And this is important too, and it's on my mind because it's been very applicable recently where there's a lot of generalized statements about the multifamily market. And when you're talking on podcasts, you kind of have to, right? We can't get too nuanced or it would be hours and hours long for basic conversations, but you got to know your market. I've got a good friend in Wisconsin who owns a lot of apartments, him and his brother, and they haven't dealt with huge gluts of supply coming online the last couple of years. There's been almost nothing in Madison, Wisconsin. And so just a totally different dynamic. And you've got to know your local market. And this is super true in any asset, right? In the land space, same sort of thing. So really important there. And I just had to mention a side point. You were talking about controlling expenses. I guess you don't deal with this in Atlanta, but if you're somewhere where it gets cold, check the snowplow contracts because we were getting hosed, man. So those are worth checking, requoting, and renegotiating because those can get expensive. So anyways, Michael, all right. I know we're heading towards the end of the show here. So we always like to ask, is there anything that we didn't ask you that you think we should have that would be pertinent to someone that might want to get into the space?
Yeah, I think really creating clarity. I think we talked about it very early in the show is really spending time to get clarity about what you want to do. Like, what are your goals? And then maybe what do you like to do and what do you not like to do, right? So there's various different strategies all the way from network marketing, digital, whatever. Then there's different real estate strategies. I can buy a franchise. I can buy a business, right? So many different things you can do. What are your goals? What do you like to do within those? And then find a strategy that matches that, right? So in my mind, there's three things that I look for in a strategy. One is I want it to be scalable, but I also want it to be passive, meaning that I can scale it without working harder. And a lot of those strategies we talked about are disqualified because I can scale it, but now we're going to work harder. I don't like that. But then also there's a risk. There's a risk. We talked about risk here on the show already. There's also a risk factor, short-term rentals. We can talk about that. I used to love short-term rentals. I got a good buddy of mine that got in like 7 years ago, crushed it. 3 years ago, he noticed that his cash flow is down because a lot of people are getting into space. And now he's been trying to sell these things because they're not he's cash flow negative. And it's because everybody jumped into space. There's also legislation that hasn't, that's affected that as well. Then there's, pad splits, co-living, also super cool. But again, legislation, we don't know. It's been around, it's untested. And so risk to me is a third component of whatever strategy you're looking at. I don't want to spend the next 3 to 5 years building something up only so that it goes away by something because it wasn't recession resistant enough or by some legislation that's passed. And when I got in the franchising business, there was a high-end pizza gourmet chain, which was awesome before the recession. And then after the recession, no one wanted to pay $25 for, a pepperoni pizza. Well, it never occurred to me that a market correction might actually affect the gourmet pizza chain. Never occurred to me. Also didn't occur to me that if the guy were to leave that I hired, I now have to run a restaurant for a little minute and I have to find someone and train someone. I didn't realize that either. So now it was scalable, but it wasn't passive and it was much riskier than I thought. So those are some things, getting clarity and then using some filters to look through some of the strategies.
I think that's great. And I think that there's so many shiny objects that are out there on the internet and podcasts and everything. And Dan and I are susceptible to it. A year ago at this time, Dan, you and I were thinking about buying and opening a pet store because there was no pet stores. And then we interviewed a guest on the podcast and they're like, what happens when no one shows up? And it's like, I guess it's us. And neither of us want to do it. But Michael, say people get clarity on their goals and they realize they want to achieve financial freedom through multifamily real estate investing. Where can they find out more about you and how can you help them achieve that?
Yeah, I have a mini course creatively called Apartments 101. So if you want to learn more about apartments and syndications, just go to apartments101.co. It's about 45 minutes long, gives you a good introduction. And it's kind of the cliff notes of the book called Financial Freedom with Real Estate Investing. It's yellow. And that's also a nice place to find out more about it. And then my podcast has the same name, also a yellow cover called Financial Freedom with Real Estate Investing. So those are some really quick, almost free ways to learn about the space.
Awesome. Michael, well, it was a pleasure getting to chat with you. We didn't even get to chat about the beautiful trophy fish you have on the wall behind you. But this is Mason McDonald and Dan Haberkas with the Big Picture Blueprint signing off.